Ladies and gentlemen, my name is Jeff Wilson. I'm a director of FGX and FGG. Let me introduce the other people up here on stage. Louise Walsh, the CEO of FGX and FGG. Then I've got Matt Hawkyard. We've flown him in from America, from Ironbridge, one of the fund managers from FGG, and I've already prepped him. We don't want too many questions on Donald Trump, but we'd be interested in a homegrown perspective because we have our own. Which that's right, I'm sure you have a similar one. Ben Griffiths, the founder of Eli Griffiths, one of the fund managers from FGX. Then we've got, that's right, Kerry Nelson from Giant Steps, that's one of the FGX charities, and Michelle Blanchard from Butterfly Foundation. That's one of the FGG charities. I'll give you the first part of the presentation, then I'll pass over to Louise, and then we've got Louise will run you through the next part with a panel session, then we'll open it up for general questions. That's just so you don't sue us. That's the disclosure, so I hope you've all read that. Excellent. In terms of what both these entities are doing, FGX and FGG, is they are trying to give investors a diversified portfolio of equities, either Australian equities or global equities, unhedged, the global equities, and that portfolio is managed by the best fund managers we could find, and to give it to you effectively for free. Now, you might think is that too good to be true? Well, there is a catch, and the catch is that 1% of the value of the assets, which is actually less than what all the managers would normally charge, because most of the managers in both of the FGX and FGG have proven performance and charge performance fees. So the shareholders get that benefit. And it's really, the 1% goes to support children at risk and youth mental health. And it is a win-win-win situation. It's a win for the investor because they get exposure to these managers. Some managers you actually can't invest in because their funds are closed. You get exposure to the managers at a cheaper price than you'd normally, the normal cost for you. It's a win for the not-for-profits or the for-purpose or the charities, because they are getting an income stream that will go on a lot longer than we'll all last. And that income stream is very high quality in terms of the cost to them and allowing them to plan in terms of long-term planning. And I suppose the third win, which is what we explain to the fund managers, is it actually is a win for the fund managers, because it's through their incredible generosity and all the service providers' incredible generosity that this is possible. And I can't thank Matt or Ben enough, because without them, this wouldn't be possible. But the win to the fund managers not only been seen as to be giving back, but also as I sort of jokingly said to them when I was pitching them, I can get you to the front of the pearly gates, but depends on what else you do as whether you get in or not. So, I mean, that's the win for them. In terms of the structure, it's a wealth creation vehicle while giving back to the community we operate in. What are we trying to achieve with FGX and FGG? It's a stream of fully franked dividends, capital growth and capital protection. Now, you'll say those last two are mutually exclusive. And how the investment portfolios are put together, these group of fund managers, is you'll see there's a number of different styles that the managers use. There's the long equities, that's the fund manager that is investing in the market and exposed to the ups and downs of the equity market. There's also the absolute fund managers that can hold a bit of cash, the market neutral managers and the quantitative managers. So what are we trying to achieve? The two investment committees, effectively, instead of this as performance, we're trying to smooth it out, get to the end point, if not above, but give you less volatility. And we've seen that proven in FGX, and it's still very early days in FGG. But the volatility is less than the overall market. And in terms of the dividends with both of them, the plan is a growing stream of fully franked dividends. FGX obviously has the advantage because they're Australian fund managers that are invested in Australian equities, so they get the benefit of the fully franked dividends of the shares they invest in, plus any profit they make that they return to FGX. FGX pays tax on the distributions, and so it's getting two lots of potential franking. In terms of, and the plan is there to gently increase the dividend. The tougher thing about trying to forecast the dividends for these two entities, it really depends on the realised profit of the underlying managers, because we're investing in their managed funds. And in terms of with FGG, because nearly 70% of the, well, first of all, the FGG fund managers are investing in global equities. So there's no free kick from the fully franked dividends for investing in Australian equities. So it really depends on whatever realised profit we get from those managers, then the tax FGG pays on it, then we pay out as fully franked dividends. And of those managers we've invested in, about 70% of them are Australian domiciled and the other 30% are offshore. So the offshore ones, we get the capital gain, but we're not getting the realised profit. They don't have to distribute it to us. So in terms of the dividend yield on FGG, it'll definitely be lower for those two reasons than FGX. But the plan is to grow that over time. And really it depends on the performance of the individual managers. At the both AGMs, you heard that the plan is to change the year end. So we'll have another AGM in May. Now, that hasn't been, that we haven't got the sign-off from the tax office, so you'll have noticed in both chairman's addresses, they were referring to the, assuming we don't get the sign-off with dividend payments, because FGG said the next dividend payment will be the full year, but the full year is coming early if we change to December. So it'll the next dividend payment for FGG is when we get the distribution from the managers for the year to June next year, and that'll be in 12 months' time. And the next FGX dividend payment will be the final dividend payment, another final dividend payment, not an interim. But just so there's no confusion. But of course, how we can't say that's the case because, say, if the tax office, for some reason says no, we want you to keep it at June 30. In terms of the other point on the slide is to do with ComSec. I mean, Louise and I saw the CEO of ComSec 11 months ago, and the whole plan was to get FGX and FGG known. Well, my view was, when I was a little kid, going to school, I had my little piggy bank, my little Commonwealth Bank piggy bank, and it was to use Commonwealth Bank for as a conduit to get young people to invest in the market, but realise you can invest in the market and at the same time you can give back or support the community you operate in. And when we spoke to them, we were talking about, can you allow people up to the age of 25 to buy shares in FGX and FGG for free? And they came back and said, look, we just think it's a fantastic initiative. They, like the various other people involved, whether it's the directors who do an amazing job, and to me we've got the highest quality directors, even though they don't get paid. I suppose, like most all the not-for-profits are the same. But they said, we're happy to allow anyone who buys shares in FGX or FGG to effectively not pay brokerage. So, which to me was a great initiative. Now I'd like to pass you over to Louise, who'll take you through the next part. Thank you.
Thanks very much, Jeff, and a special thanks to you for creating both companies, because we all certainly wouldn't be here and I wouldn't have this fantastic gig, which I think is probably one of the best CEO gigs in the country, so thank you. I'm now going to run you through an update presentation on both companies, starting first with FGX and then FGG, and then we'll have a short panel discussion with our two fund managers and Jeff, and then we'll finish things off with a panel session with two of our recipient non-profits from FGX and FGG. So firstly, just starting with FGX, Future Generation Investment Company. First of all, I would absolutely like to acknowledge and thank our fund managers who make FGX possible. We currently have, we're invested in 19 funds managed by 18 managers, and we've just added L1 Capital from Melbourne to that as well to make it up to 20 fund managers. We're pleased to have Centennial and CBG added in the last financial year also as fund managers for FGX. Then moving on to acknowledge and thank the 14 non-profits or charities that are recipients in FGX. These were chosen, they focus on children and youth at risk, and they operate nationally, most of them, but a significant number of them absolutely operate in Sydney and New South Wales. And I'll talk a little bit more about the impact in this space a little bit later. I'd also like to acknowledge the FGX service providers. So these companies or firms, anything from the back of house finance or accounting through to legal services, etc., that are working pro bono for us. They're incredibly generous along with our fund managers. Taking a look at the FGX performance, in a nutshell, firstly, just to highlight some key things that were in the annual report, an 18.2% increase in the pre-tax profit to 17.75 million, a strong risk-adjusted return, savings of 6.28 million, which were delivered from pro bono management and performance fees from our generous fund managers, as well as our pro bono service providers. A 2.29 million donation to Australian charities, primarily focused on children and youth at risk. This represented a 39.6% increase from the previous year's donation of 1.64 million. And lastly, a fully franked 4 cents per share full year dividend, a 100% increase on the 2 cents per share fully franked dividend for the period to 30 June 2015. If we take a look at the performance now of FGX, there has been strong outperformance since inception. In the 12 months to 31 October this year, the investment portfolio has increased 9.1%, outperforming the benchmark with less volatility as measured by standard deviation of 8% versus the market's 13.9%. 0.4% in what has been a challenging investment environment. If we look at now the net tangible assets, as at 31 October for FGX, the NTA after tax of essentially 113. I think the share price this morning was 114, so obviously it's trading slightly at a premium to NTA. The investment strategy allocation, if we look at this, it's as you can see here, 37.4% long equities, 22% absolute bias, market neutral of 14.1%, and cash at 26.5%. We're partway through the process of allocating the monies raised from the exercise of options, which I'll mention a little bit later. If we then look at the allocation amongst the individual fund managers, as you can see here, no one fund manager has more than 10% allocated, and at the moment Regal Funds Management has the biggest share with 9% of the assets, and it scales down from there. I mentioned the options. We were delighted with the outstanding result of options that were exercised in mid-September this year for FGX. 89.9% of the options were exercised, which raised an additional $180 million for the company. I talked before about and mentioned the charities or the non-profits, and this just gives you a summary of some of the impact of where the donation has gone in the financial year 2016. Just to highlight a couple in Sydney, for instance, or New South Wales, Australian Children's Music Foundation, 4 specialist music teachers were employed for over 1,500 disadvantaged students throughout New South Wales and some in Victoria as well. We take a look at some further ones here. Youth Off the Streets, the last one, a cultural mentoring and support for 200 disadvantaged Aboriginal youths between the ages of 12 and 21. So we're extremely proud and pleased with where that money's of that donation is being spent in the last financial year. Now I'd like to move on and talk a little bit about FGG, Future Generation Global, and we'll certainly have time for questions at the end. I'd firstly like to acknowledge the fund managers, again with FGG, who have been incredibly generous in supporting the company. We currently have 17 fund managers invested in 19 funds. We're now showing some more detailed information about the performance of individual fund managers as we profile them in our monthly NTAs. So the next one will be due out on the 14th of December. Now I'd like to acknowledge the 8 non-profits or charities for FGG. So these are focused on youth mental health. They all operate nationally, and most of them actually are headquartered in Sydney, in the city here. The service providers for FGG, you can see here we've probably got a few more than FGX, and that's really because we did the IPO for FGG, of course, 12 months later, the second time round. One I'd like to acknowledge is particularly Lonsec. Amanda Gillespie, who's the CEO of Lonsec, chairs our investment committee for FGG, and Lonsec provides some very detailed research reports for the investment committee of FGG, which are vital when they meet quarterly to look at the performance of the individual fund managers. Looking next at the FGG performance, just a few highlights in this regard. Firstly, the inaugural donation of $2.4 million that went to charities primarily in the children and youth at risk space. At the next investor presentation, the shareholder presentation, we'll be sharing with you our social impact evaluation framework, so you can really see how the money is being spent every 6 months when we do these presentations. A $6.1 million profit before tax and savings of $3.2 million, which have come from management and performance fees foregone by fund managers, as well as pro bono services provided by our service providers. A 1 cent per share fully franked dividend, as was mentioned earlier before, is the final highlight. Looking now at the performance of FGG, we're delighted in particular that since the start of financial year 17, that the investment portfolio has actually outperformed the index in each of the first 4 months. It has been a challenging global investment market. The performance of some fund managers, as has been said earlier, was impacted by the renewed strength of the Australian dollar and the underperformance of some Asian markets. The NTAs, the net tangible assets for FGG, as at 31 October, you can see here was 105.85. The share price today, 107. So obviously it's trading at a slight premium like FGX to NTA. The investment strategy allocation, we're looking here currently at long equities at 56%, absolute bias of 32.1%, quant strategies of 6.4%, and the remainder at this point in time of 5.5% with cash. And finally, the allocation amongst the individual managers as at 31 October. Magellan has the highest allocation at the moment with 10%, and then you can see how the rest of it scales down from there with the other individual fund managers. And lastly, these are our contact details, so please be sure to follow up with us and give us feedback, because we're very keen to improve things with our comms, etc., where we can. So that precedes my sort of formal presentation, or concludes, sorry. And now what I'd like to do is do a short panel session with two of our fund managers. As Jeff said earlier, he introduced Matt Hawkwood from Ironbridge in the US, based in Chicago, who happens to be here in Australia this week, as well as Ben Griffiths from Eli Griffiths, who is our fund manager representing the FGX fund managers. And I'd also like Jeff to actually participate in the panel as well. So the first question for all three gentlemen is, could you, in a summary form, give us your views on the market outlook? So I'd like to start with Jeff, thanks.
Thanks, Louise. I'm very bullish. I just want to see... no, only because we did it 2 days ago in Canberra for the first time with Ben. No. Benny's bullish and I'm more bearish. I'm of the view, what worries me is we've got these record low interest rates that have pushed valuations to what I believe are unsustainably high levels. And we're in a very long bull market in the US. And it's at some point in time, the easy money or that's been flushing around the globe, that has to be, it can't continue at this level. So it really, I'm concerned about bonds backing up and valuations coming down because of that. In terms of the funds we manage, we're 42% cash, but that's how we invest money. We default to cash, so but which is higher than what we've been for the last 18 years. On average, we averaged about 34% cash. So that's our current view. Thanks.
Good. Thanks, Jeff. And what about you, Matt?
I guess I'll take a quick diversion. First of all, I'd say I agree with Jeff kind of wholeheartedly. But I think one of the effects of that has been what we've seen politically. When the GFC hit in 2009, central banks basically started quantitative easing, and they flushed the world with a lot of cash, which raised asset prices. And as asset prices raised, there was a certain class of people that benefited, the people that owned assets. Here in Australia, because of superannuation, I think it's a little more, people are a little more immune to it. But to give you a sense, the average person in the United States has maybe $500 in their checking account and expects to get paid in Social Security. So there's a lot of disenfranchised people, and I think you also see that in, if you look at Brexit and you look at who voted for it and who didn't. With London, I was amazed. That's basically everybody who voted to stay. Guess who has the assets, right? And everybody who voted to leave was outside of London. So as part of that result of quantitative easing, you've got a lot of disenfranchised people around the world, and I think that's probably what, if you're going to ask me afterwards at the cocktail hour, how the heck did Donald Trump get elected? A lot of it has to do with central bankers, believe it or not. But I agree in the sense that if you look at valuations, they're at the very, very high point. The thing that concerns us at Iron Bridge is the uncertainty. There's a tremendous amount of uncertainty that's headed, obviously, in terms of a transition in leadership in the United States. We have a referendum on December 4th in Italy, and then a big roll through of elections in Europe, combined with what's going on in China, in Japan. There's a lot of uncertainty and a lot of question marks that go along with very high valuations. So we have a fair amount of concern with overall markets.
Thank you. Thanks very much, Matt. And Ben.
Thanks, Louise.
Benny the Bull. Hey.
It wouldn't be a gathering, ladies and gentlemen, with that Jeff Wilson position at one end of the discussion and myself convened at the other end. That's just how it goes. It's been that way for a decade or more. Look, I would share the sentiments to some extent of the previous speakers. I'm anxious about the uncertainties out there as well, as much as any other investor is. But one thing you can bank on is that stock markets have an uncanny habit of climbing the wall of worry, as they say. Anxieties can be soothed somewhat when valuations are about right. What we really need to be concerned about as investors is when valuations are out of whack, out of step. PE ratios, which many of you will be aware of, are a great measure of a market's fundamental value. PE ratios are not out of step with long-term valuations. The Australian stock market is barely above its 20-year average. The US stock market is a little above, but not alarmingly above its longer-term average. So if you're looking at PE ratios as your fundamental yardstick, valuation yardstick, you shouldn't be too anxious. Second point I'd make is, not that I would expect individual investors to do this, but certainly at the professional end of the market, we have tactical allocators who essentially decide, am I putting money into bonds or am I putting money into equities? And the argument in favour of equities, as in the dividend yield, or earnings yield more correctly, versus the bond yield is overwhelmingly supportive of the case for equities. So equities, when you look at them in terms of bond yields, are cheap. And you look at them in terms of longer-term averages, average PE ratios, they're also in line with fair value, and in the US, possibly mildly expensive, but nothing dramatic. And I'll leave you with one final point before we advance the discussion beyond equities. Are we uncertain or are we bullish or bearish? And that's essentially, there's too much nervousness around. There's too much anxiety, as detected in the previous two commentators. And I think they're right to many extents, but the market has well and truly discounted that. Have a look at the positioning of a large number of fund managers. They've got a lot of cash, both here and offshore. Some of the long-only managers in the US have got too much cash, and some of the hedge funds are basically long all the wrong stocks. That is, the stocks that are performing well, they're not long, and they're short the wrong ones. So the positioning is wrong. The market, as a group, whether it's here or offshore, is positioned for bearish outcomes, negative outcomes, and I think that's wrong. And the price action since Donald Trump got in should reassure some of us that the line of least resistance for equity markets, in my opinion, the line of least resistance is up, not down. So I'm a little more constructive, notwithstanding the anxieties and concerns out there regarding the outlook for markets.
Excellent. Thank you very much, Ben. Appreciate it.
Hey, next time I'm going to be last.
Okay, I'll do that. Right. Okay, give you the last.
Hey, because I've worked it out.
Yeah.
So both times he just picks us.
I think that's Ben's last time up on the podium, Jeff.
Oh,
probably
yeah.
another year or so. So we'll see how we go. The next question relates to one or two stock picks that you might like to share with the audience. So, Jeff, do you want to go first or last this time?
No, I've got 4 stock picks. No.
4.
No, last time I had 3 with Benny. I'll stick to the same 3. And one's a micro cap Australian one, Armidale Investment Corporation. We've been talking about it on our roadshow. I was at a conference here, and you don't buy it at the moment because, unfortunately, well, to talk about it, since I mentioned it at the conference, it's up 30%. So you're just making a profit for other people. But if the share price comes down to around that 14-cent level, I think it's a financial services roll-up, which is difficult, but it's with people that have done it successfully before. The major shareholder and one of the management team was at Steadfast, and he was successful in developing that business, and that's insurance broking, and this one is asset broking. And it's moving from an investment company to an operating business. And it's probably a 5 to 10 year story, but it's short term. It's too expensive, so let it come back. The other one is very sad. What's happened with Ardent Leisure, which is now Main Event in Dreamworld, but again, probably picking Ben's point up, all the bad news is in the company, and their main business, where they're selling all the Australian assets, their main business is theme parks in the US, which is Main Event, which is growing from 30. It's got a phenomenal growth story from, I think, 30 theme parks to 200 over the next X amount of years. And it'll probably get taken over by US private equity before it gets there, once they've sold all the Australian assets. And I think Dreamworld was on the block to be sold as well. And the third one, just moving up the scale in terms of smallest to largest, is QBE, which after having a tough period, things are starting to work for it, where the bond market's backing up, and so interest rates are going up, which is QBE's got enormous leverage to pick up at interest rates. Also, insurance premiums are hardening, and when we had a recent meeting with the company, they've got excess capital, I think, of $1.2 billion. We think there's a high probability there could be some capital management initiatives. And so, there are three things that are very positive for it.
Good. Thank you, Jeff. And Matt, from a global perspective.
From a global perspective, I guess I'll give you one area to be concerned about, and we can talk about a couple stocks. It was interesting, I think, of the nature of the election. As you talk about kind of high uncertainty, Japan opened up down 6%, and then the U.S. ended up 2%. So in terms of just the volatility that's out there. But one thing that was common thread across the world, as we talk about kind of the end of quantitative easing and the end of monetary policy extension, is we started to see a bump up in interest rates, whether it was Japan forcing a negative yield curve to become flat, because basically flat to negative yield curves are very bad for banks. And things that are bad for banks can be very systematic risk, as we saw with the global financial crisis. And so we tended to be a lot more bullish on banks kind of going forward, particularly within the U.S., as we see regulation starting to unfold with Dodd-Frank. The one we own is First Republic Group, is a small California bank. Basically, if you were going to start a bank, this is it would look like this. Basically, they deal in high net worth folks, venture capital partners, lawyers. Incredibly, they service their clientele very, very well. Their loan loss provisions basically are about 10 basis points. So they don't lose money. Well, basically, if you think about their clients, their average client goes and buys a home with cash and then might borrow some money. They lend to foundations. They would lend to a group like FGG if you needed money. So that's the type of company that if you needed that, basically that's how they work. So it's a great bank. So as you think about financials in general and interest rates, we would be much more bullish on financials. And then the flip side of that, the other side of it is we'd be a lot more cautious on your bond proxies, which would include utilities, REITs, P&C insurers, tobacco companies, kind of non-growth staples. In general, we'd be pretty negative around those types of companies, just because as you see interest rates start to go up, we'd be a little more concerned about that general area of the market.
Okay, thank you. And finally, Ben, have you got a couple of picks there?
Louise, I have got a couple of stocks today. Two names. One will be reasonably well known to the group, and perhaps one isn't. Both are held in good size in our portfolio, so I'll declare my hand early. New Farm. New Farm is an agricultural chemical company that has, by nature of the industries that it's in and the geographies it services, it is typically a volatile earner. But good fortune seems to be raining on New Farm, no pun intended. In its pursuit of its geographical diversity, New Farm has enjoyed the benefits of a La Nina event that, of course, blessed the east coast of Australia, where bountiful rains have meant bountiful crops. New Farm specialises in pre- and post-emergent chemicals. You treat the soil before you sow. New Farm provides those chemicals. It's got a major share of the Australian market. It also has an important and growing share of international markets, such as Brazil, extensively through North America, and of course through Europe. So the backdrop, the operational, the environmental backdrop is not too bad for New Farm. In fact, it's good. At the same time, we have a turnaround underway. We have a couple of new managers, a new CEO, a CFO that's been behind the wheel for 2 or 3 years, a new investor relations company counsel, and several other general managers within the group. And these individuals, who I've met on several occasions, are doing a tremendous job in resetting the New Farm business, cutting enormous cost out of the business, divesting assets, and they are also, we think, preparing or sizing up or considering what assets might fall out of the numerous international ag chemical tie-ups. You've seen DuPont and Dow Chemical tying up, Monsanto attempting to tie up with Bayer. No doubt about it, regulators will only approve those transactions, those large mega mergers, with some asset divestments. And a lot of the second-tier ag chemical producers, such as New Farm, would be sitting in wait or lying in wait for the assets that might just fit their portfolio. So we're thinking that something might well fall their way. That's not the premise of an investment case, but it's certainly a very sensible and logical way in which they'll be able to grow revenues, in addition to better seasonal conditions, in addition to right-sizing and improving the quality of the book. So we like New Farm, we like it greatly. Next week's their annual general meeting, so we'll actually get to hear firsthand how the business is travelling, but we think it's probably going okay. The second stock is at the very small end of the spectrum, a stock that we own about 8% of, so I declare my hand early, and that's Australis Oil and Gas. And Australis Oil and Gas is essentially run by the founders of Aurora Oil and Gas, which was an incredibly successful US shale oil and gas operator that got taken out by a Canadian company called Baytex. All involved, including our fund, made great profits on our exposure to that business and its ultimate takeover. The principals behind that are getting the band back together, as they say, and are launching forth with a new business in the United States to take advantage of cast-off assets being sold by distressed oil and gas players. They've got a decent-sized chequebook, not big in terms of global oil explorers and oil developers, but a good-sized chequebook all the same. They're onto a few ideas, and we think over the next 2 to 3 years, you'll see the beginnings of, and in the makings of, I should say, a mid-tier oil and gas company that'll generate profits, generate revenues and hopefully profits, and grow its share price. So it's at the very small end. It's the usual caveats go with investing in very small companies, but so much of what we do and what my other fellow commentators do is backing good management teams in good opportunities that are sensibly priced. So I think each of New Farm and Australis are. They're my 2 tips. I'm happy to stand behind Louise. Thank you.
Great, thank you.
Hey, Louise, can we
Yes,
ask
Jeff.
Matt, because he won't be able to publicly talk about Trump?
Sure. Yeah, a few thoughts on the
Yeah, just
the
take
victor?
take us through your new president that you must be very proud of.
Yes. I guess with trying to be, on the spot, right? You turn up the. I think as you looked at the way the election works in the United States is you have a primary, and in the primaries basically you go after your base, okay? And so typically what will happen is you swing far to the right or far to the left, and then when you come back to the general election, you start to get more neutral and you try to get the people in the middle, and the rhetoric calms down after the. However, as you saw in the case of Donald Trump and Hillary, it was probably one of the ugliest globally, elections. And from an American who travels, one of the few that travels around the world, probably, I think only about a quarter of us have passports. It was embarrassing in terms of just, you're waiting for someone to ask you about, what do you think about your future president? And I think what you've seen since he's been elected is a walking back of a lot of that rhetoric and looking at trying to basically be much more presidential, looking to hire John Kerry as his Secretary of State, who is well respected, looking to hire guys like a Jamie Dimon to run the Treasury, who is also very, very well respected. So I think from the initial kind of shock and awe of the way he went about trying to get elected, to me, it was interesting because basically people had kind of made up their minds and didn't change. In terms of if you go to Green Bay, Wisconsin, which elected Barack Obama 8 years ago, flipped and elected Donald Trump this time around. And that's a kind of a very blue-collar, they used to call them Reagan Democrats. And so people were, basically, there's just a massive disenfranchisement. And so I think people were looking for change. And so what resonated was basically we want somebody completely from the outside, regardless of all the other stuff, which wasn't great, I think, from a global perspective. But the other way to go about it, too, is he's starting from a point of negotiation. And I think the biggest issue when you're dealing with politics is politics typically should be a negotiation, but they don't negotiate. They try to be politically correct. As an American or as a business person, you get a sense of what he's trying to do, but it makes you squirm a little bit. But I think in terms of talking about the wall and Mexico and getting out of TPP, the reason he wants to get out of TPP is he wants to go with bilateral agreements. He'd rather go direct because he's holding a rather large wallet and would rather directly negotiate with countries as opposed to get into a big group where everybody's kind of compromising. So I think it won't be as bad as probably people worry about, but keep in mind you're dealing with a very, very good negotiator. So he's starting from the point of kind of putting the fear of, I don't want to say the fear of God, but the fear of God in a lot of people in terms of what's going to happen, isolationism, and everybody gets a lot worried about it. But if you look at his actions and kind of how he started to walk back on some things, it won't be quite as, or at least as a, trying to be hopeful, I guess, is in a point of change. We'll see how it goes about, but it'll be, at a minimum, sitting here in Australia, it should be a little entertaining.
Well, we're certainly watching with fascination, I can see that.
So another question, sorry.
One more.
These are my Trump questions. Because a few people, maybe we're a long way away, they question whether he'll make 6 months, as in physically make it, like, boom.
Yeah. Oh. Well, he was a fan of the NRA, so there's a certain irony in that if something like that happened. But I think it's again, it comes back to as I said, seeing him walk back, because I think there was just as much anger around Hillary, and if you look at the parallels between the Clintons and what you've seen, in the House of Cards and things like that, you look at it and say, geez, there's not too, the leaf didn't fall very far from the tree. But you can look at things and say neither candidate, you could probably say something like that about both candidates in terms of the extremes, whether it was the right or left in terms of the hate factor. Neither one of them, I think from a political perspective, they were more disliked than liked. So I think, you'll see how the transition team comes in, and if he can get some high-profile business people and some rational people, I'd say some professional politicians in there to kind of calm some things down. It'll make people feel better about it. Part of the worry was, as I said, some of the appointments he's had have initially were a little concerning around his head of strategy, who ran an ultra-right newspaper. And obviously he doesn't control everything that's printed, but he sits on top, and so he has to take some responsibility for that. But as I said, if you look at John Kerry as an appointment and some of the other folks, hopefully it will be a little more calm. But as I said, the hate factor is definitely on the higher side, but that's why people get to protest and do what they want to do.
Yeah. Thank you, Ben. I think Ben's just got one
I-
final comment.
Just dying to jump in on this one. Really, if as an investor all you do is follow the weight of money, which is what we do all day, every day, and I built a career around following the weight of money, the performance of that US stock market since Trump was firming up and since, in fact, he was announced and declared president, is extraordinary. It's not just the Dow, the 30 stocks that make up the Dow Jones, it's the 2,000 stocks that make up the Russell 2000 benchmark, which is an extraordinary measure of that US economy. I think it points to a number of things. Has the market got it wrong? Possibly, but that's a large-scale error if we're seeing the extent of the advance that share markets put on. I think it's extraordinarily encouraging, the response the market's had, and clearly the market only goes up because money's been drawn to the market, whether it's local investors or international. And if Trump's halfway successful in urging the repatriation of the $10 trillion that sits in offshore bank accounts for US corporations, that's an enormous fillip to that economy if he can somehow coerce the money back to the US and put to work. So, I don't know, I read the machinations of what's just happened rather bullishly.
Yeah, I think I would add, we have a small cap fund, which has really done well, as you talked about with the rise of the Russell 2000. And I think what you've been seeing is people selling bonds and going in saying, we want to own the U.S. And there's two ways to own the U.S. You can own U.S. small cap, which is basically highly invested in the U.S. economy, or U.S. large cap. And in the U.S. large cap, 50% of those revenues are going to come from overseas. So you've seen a massive move in passive towards the Russell 2000. So I think that's a great point. And then the other thing is, in terms of what's happened with the U.S. market, we always think about it in terms of valuing cash flows and looking at discounted cash flows and what's happened with the discount rate. And things that affect the discount rate are inflation, or investors' cost of capital are essentially inflation and taxes. And one of the things he's talked about is lowering taxes kind of across the board, whether it's for cash overseas or lowering taxes for investors. And if he's going to lower capital gains taxes, that's very bullish for the market. So I think that's also in terms of the expectations around that.
Yeah, great. Thank you. Thank you, gentlemen. Interesting panel. Sorry we have to cut it off, though. So to round things out, I'd like to welcome Kerry Nelson, who's the CEO of Giant Steps, one of our recipients in FGX, and secondly, Michelle Blanchard, who's come up from Melbourne and who is the National Manager for Programs and Practice for the Butterfly Foundation for Eating Disorders, one of our FGG non-profits. So just, ladies, you know, it's always a tough question, but in 1 minute, what's your elevator pitch on what both of your organisations do? Can I start with you first, Kerry?
Oh, sure, and thank you very much. I appreciate being here. Giant Steps, we're an organisation that supports children and young adults with autism. Autism is by far, when we wrap all of the disability types together in Australia, autism kind of trumps them all, in that we've got a population about 1 in 66 children born will have a diagnosis on the autism spectrum disorder. So in every 2 classrooms in Australia, you have a child with autism. So Giant Steps, founded 20 years ago by a group of parents who were looking for an educational opportunity for their children, started a school over here in Gladesville, in the old Gladesville Psych Hospital. We now run 2 schools. We run a college for young adults. We run a mental health clinic, a research program, and a clinic for newly diagnosed babies from about 6 months to 18 months, and an outreach program. So it's very much a growing organisation, and we want to be at the top of our game. So we do a lot of work in research and a lot of work. I actually work probably 3 or 4 days a week, actually with the children, trying to figure out the best ways of educating our children with the social deficits that they have. That's us in a nutshell.
Great. Thank you very much, Kerry. And Michelle, can you tell us a bit about Butterfly?
Absolutely. So the Butterfly Foundation is Australia's largest for-purpose organisation that supports the needs of people living with eating disorders. And eating disorders are probably one of the most complex and challenging mental illnesses that affect people right across the lifespan. And our CEO, Christine Morgan, is incredibly sad that she's not able to join us today. And the reason why she's not able to join us is that she's comforting a family whose daughter is dying from anorexia nervosa. So there's 2,000 deaths as a result of eating disorders every year. So it's an absolutely serious and incredibly tragic circumstance. So what we try and do at the Butterfly Foundation is really change the conversation about eating disorders in Australia. It's an area of mental health that has been underinvested in for a very, very long time. We have people around Australia who need to leave their home state to be able to receive adequate treatment and support. So our role is really to advocate, but also to develop and trial new treatment models to meet the needs of people with eating disorders. We do that through our prevention programs that have reached about 600,000 young Australians over the last 10 years, our national helpline, which reaches about 10,000 Australians every year, our recovery support services in communities across the country, and our intensive outpatient program, which I can share a little bit more about today.
Great. Thank you very much, Michelle. Second question, ladies, is can you remind the audience of the donation amount that you've received? Kerry, you've had two, and
sure.
Michelle, you've had one, and what exactly that money is being spent on, the Future Generation donation?
So the first donation of around $108,000 was received, and what we did with that was to start a new school in Melbourne. We have an enormous demand point in Sydney of over 500 families on our waiting list wanting their children or their young adults to come to our school or college. And a lot of people do travel both internationally and across Australia to attend school. So we were able to actually take a risk. It allowed us to take a risk and to set up the school in Melbourne. It's now operational, it's in its first year. It started off with 2 classes, and next year it will double in size, and then it will double in size again. The demand point down there is about 200 families on our waiting list. So that's been just a terrific move forward. And the second donation was of 163,000, I think. My memory might be fading there. And what we're doing this year is looking at the core deficit of autism. The core deficit's around social communication. And it's quite misunderstood. So our speech therapists are developing a centre of excellence and looking at what does social communication mean, and then how do you teach it. So if I can give you an example of that, you're all really very, very good at being are good communicators, and part of that is your sixth sense about social communication. So I can pretty much tell by looking at you from your body language whether you're bored or interested. I can pretty much predict how you're feeling if you're wiggling on your seat. All of those sorts of things. I can tell the interactions that are going between partners in the room, or we're giving a sideward glance, or all of those sorts of things. And they're the things that you learn almost by osmosis. You're not actually taught them, but for our children, that's the core of their deficit. So how do we teach things like body language or eye gaze or eye flicker, all of those sorts of things that allow you to be competent social beings within your environment. And then the second part of that is that you all learn via your social communication. The only other way that you learn is by trial and error, and you do very little trial and error learning these days. So the majority of your learning is with your social communication tool that you have. So it's a real challenge for us to try and figure out how to do that. So this year's work is around all of that social communication and sharing that resource via kind of a blog, as well as setting up a centre of excellence where we have teachers and therapists working together to share that information and to give that information to everybody who would like it. So that's the challenge of this year's work.
Thanks, Kerry. And Michelle, from Butterfly's perspective.
Yeah, so we received our first contribution of $291,000 back in September, and we're using those funds to develop a world-first intensive outpatient program for adolescents with eating disorders. So eating disorders typically commence during adolescence, particularly between that 15 and 19-year-old age group. And we know that the sooner we intervene, the better the outcomes are for that young person and their family in the long run. So what we're doing is taking a model that's been really successful in the United States. It was developed by a woman called Carolyn Costin at a place called Montenegro. And in fact, there is a growing community of Australian families who have paid a lot of money to take their young people to Montenegro to receive treatment and support. And it's come back and they've recovered and are now doing well. So we're taking the principles of that program and delivering it here in Sydney. So young people will come into the program via community mental health organisations, via schools, via general practitioners, and they'll participate in 3 sessions a week over an 18-week period. And what's unique about this program is the high therapist to client ratio. It's a really supportive environment, but also the integration of what we call meal support. So you can imagine if you're a young person who's experiencing anorexia or bulimia and finding eating incredibly challenging and traumatic, often the approach in hospitals is to sit and supervise, and that can be really scary and really quite risky. Our approach is that our therapists sit side by side with that young person and they role model a healthy relationship with food. That, coupled with evidence-based treatments like cognitive behavioural therapy and family-based therapy, tend to result in really good outcomes. So we know that the sooner we intervene, the better. So what we really want to do is provide an opportunity for young people to engage in treatment early, for us to throw everything we can at this insidious illness, and really try and get those good outcomes in a timely way.
Thank you. Thanks, Michelle.